First idea, Canadian natural resources.
Okay, so, sort of continuing with the energy exposure, so we added this fairly recently. Obviously, this is well known to Canadian investors. It's an energy major. What we like about this is the sort of, again, the religion, financial religion that the oil patch now has. Not destroying wealth, paying shareholders, growing dividends, buying back shares, special dividends, and so forth. So Canadian Natural is effectively retiring about 1% of shares outstanding a month. And we think over time that that's going to continue to grow. We think there's scope for special dividends. And as long as the religion prevails and they don't destroy capital, then the energy patch is a great place to be. We've got a ton of oil, probably just as much as the Saudis, so a good place to be. And at these levels, we think it's an attractive entry point, and I think this is going to be an accretive hold for a longer period of time.
Open text.
Yeah, so OpenText is a bit of a different story. So I've owned this on and off really since sort of the 2000 timeframe when I first encountered the company when I was doing venture capital. And so what happens is the company has periodic, often downs or significant declines in the Q3 because it's a lumpy company. Anyway, the market didn't like that it bought a company in the UK, Micro Focus. But the vagaries of UK acquisition law are such that you can't disclose the rationale for the transaction until the transaction is closed. It doesn't close until, I think it's January 31st or possibly a little bit of slippage thereafter. In any event, once the transaction is closed, the rationale for the transaction, why it's being done, the financing and so forth will be discussed. Ton of recurring revenue, so very sustainable business model, a growing dividend, and we think that there's some upside from here. And typically when you buy it on a significant dip, it tends to be reward you. So it's attractively priced. We like it, and it's a company that we've owned on and off for a long period of time, so we know the company well. We actually spoke with management fairly recently, and it was good.
So, sorry, you may have touched on this. It does sometimes produce these misses, and then the stock goes down, or the stock.
Yeah, and so in this particular, point that happened. But the other thing I'd flag is there's been significant insider buying from the board. I think Tom Jenkins bought 750,000 shares with cash, not with options or phantom money. So he's the chairman of the board. So obviously he knows something that we don't, and he's exercised that decision with his checkbook.
You like to see that, do you? Actual cash rather than phantom money, as you put it.
Yeah, like when the board writes real checks rather than just cashing their coupons and just trading for their tax position. But the better situation is when management actually want to have more capital in the business, and when they do that with real money, that's a tick in my book.
And then finally, Medtronic, 46 years of dividend increases?
Yeah, so it's a dividend aristocrat. It's very attractively priced. We will obviously expect that the dividend increases will continue. Like all tech stocks, it's retraced a little bit. And obviously there's from time to time with bigger companies, there's a mix issue, and one business is working well and one business is not. There's also the concerns around US unemployment, but US unemployment is tied to healthcare. And here's the buts. US labour participation is still very high. The balance sheet is very strong. It has a history of being a tuck-in acquisition story. So as opportunities become cheaper, they're likely to buy something. And so at these levels, very attractively priced, long-term dividend track record, very supportive for shareholders, and it's a sort of something that would be part of our sort of traditional DNA: buy, hold for long periods of time, and trim it when it gets overheated.